Have you ever wondered how to make money while sleeping? Hi, this is Mosh. Today is all about passive income through dividend investing. I'm going to explain to you guys why you should buy stocks that pay dividends for you to get a regular income, show you some calculations, and show you my whole dividend portfolio. Firstly, a dividend is a distribution of the company's earnings, basically all the profits that it makes to its shareholders. A condition needs to be met for you to receive a dividend. You have to buy that dividend stock before the ex-dividend date. If you buy after that, you won't receive the dividend for that quarter or for that year. Dividends are generally paid quarterly, some companies pay yearly, and there's some companies that actually pay monthly. You have to decide what type of payment is best for you. I also think it's important to know what type of stock you own. Most stocks found in the market are common stocks. They come as two classes, Class A and Class B. The only real difference between Class A and Class B of common stock shares is basically Class A, you get voting rights in the company, whereas Class B, you don't. There's also something called preferred stocks, which not many people know about. So you get paid the same amount of dividends as Class A and Class B shareholders. However, you get your dividend first. Also, if the company was to go bust or to get liquidated, you would have a repayment priority over common stockholders. So that's something to be aware of. But in terms of payments and how much you receive, it makes no difference. Why should you do dividend investing? If you're saving money into a bank account, and let's say your bank account is offering you 1% or less, and the rate of inflation is 3%, you are actually losing money. You are losing 2% of your wealth yearly. Let that sink in. Some people may argue that banks is the safest, but I would say if you're investing for long term, I would say the stock market is just as safe as the banks. There's many different types of dividend stocks. However, there's two main categories which I think are the safest. The first is the dividend aristocrats. They are a company found in the S&P 500 that have been paying dividends for 25 years at least, and they've been increasing the dividend payout every single year. Next category is dividend kings. They are companies that have been paying dividends for at least 50 years and increasing it annually. The only difference is they're not found in the S&P 500. Now you may find a dividend king that is actually a dividend aristocrat because they're found in the S&P 500. Next thing you need to look out for is what the dividend yield is. It will show you how much you're going to be getting annually. Dividend yield is worked out by the dividend paid divided by the price of the stock. I'll give you an example. Let's say the dividend per share is $2 that the company is going to pay, and the price of the stock is $30. So $2 divided by 30 times 100, that gives you a dividend yield of 6.6%. So if the dividend yield is 6.6% and you put in $1,000, that means you'll receive $66 yearly or $16.5 per quarter. So that's every 3 months. One thing people overlook is the dividend yield changes based on the price of the stock. So before we had a dividend yield of 6.6% if they paid $2 dividend and the price of stock was $30. Let's say the price of the stock drops to $20, but they still make a $2 dividend payment. So now if we do $2 divided by $20 times by 100, that gives us a dividend yield of 10%. So you can see, because of the price dropping, your dividend yield has increased. The opposite is true as well. So let's say they're still paying $2. However, now the price of the stock has gone to $35. If we do $2 divided by $35 times by 100, it gives us 5.7% dividend yield. That's something to be wary of. The price of the stock changes your dividend yield. I'm going to show you my Freetrade portfolio and the stocks I hold. As you can see, my portfolio is up 11,097%. Yes, that's right, 11,097%. This is not fake. And the reason why it's so high is because it's made up of entirely free shares. So a massive thank you to everyone who's been using my Freetrade link. Every time someone uses that link, they get a free share and I get a free share too. So if you haven't done so already and you want a free share worth up to £100 from either Freetrade or Trading 212, go use my link in the box below. Deposit £1 and you get a free share worth up to £100 from Freetrade or Trading 212. So what I've been doing a lot this month is I've been selling those free shares and buying dividend stocks or ETFs. And the ETFs and the stocks I've been buying generally have a high dividend yield. I've also left some stocks in there that already have a high dividend yield. So first up, my biggest holding is the Vanguard FTSE All World High Dividend Yield. If you're not sure how index funds work and how Vanguard works, I done a full video on Vanguard ETFs. Go check it out in the link at the top. So I hold about 8 shares, £361. And the key factor here, if we go to the dividend yield, it's about 2.5%, which has slightly dropped in the last few months. However, this is a basket of companies. So you've got hundreds of companies in here that are paying a dividend. So it's probably the safest option to receive a dividend. Next, I have Uber. I actually got 2 free shares of Uber from Freetrade. They actually give no dividend, but I think it's a very good growth stock, so I'm just going to keep it there for long term. Next up is Telefonica. If you know the company O2, they actually owned by Telefonica. It's one of my favorite dividend stocks. So if I go here, it actually gives an 8.82% dividend yield, which is ridiculously high. Especially with the 5G rollout, I think this dividend yield will hold or potentially increase. Your bank is offering you 1% savings rate. Government bonds is like 1 to 2%. Whereas Telefonica, they're giving you 8.82%, which is a ridiculous amount. Next up is Aviva, which is insurance company. Again, this is one I've been buying and I managed to get 2 free shares, as you can see from it. It gives a 5.21% dividend yield, which is really good. Considering they're an insurance company and a lot of people are putting claims, they showed strong profits as well last financial year. Next up is another one of my favorite ETFs. It's the Vanguard S&P 500. This doesn't have a high dividend yield, but it still has a dividend yield, which is incredible. It's at 1.13%, almost the same as the banks. And we know the S&P 500, the average annual rate of return is about 9% every year. So the price of the S&P 500 stock goes up 9% every year. So you're automatically beating the banks. Next up is ETP. These are actually free shares I've been given, as you can see, and some of you may have received that as well if you use my link. It's a natural gas company and operates pipelines. And as you can see, the dividend yield is incredible, 5.99%, which is really, really good considering the gas prices crashed last year. Next up, AT&T, which everyone's probably familiar with. This was actually a free share, which I held on. It gives a dividend yield of 6.93%, which is really incredible. And again, with 5G rolling out, this could potentially increase over the years. Okay, this is just my Global Clean Energy ETF. I had a lot of these shares in my Trading 212 account, but actually sold all of it out. I'm going to rebuy because it has taken a big dip. They pay they do pay dividend, which I'm surprised about. I didn't think they did, at 0.65%. So this is a massive growth sector. Next up is Tate & Lyle, which is a British sugar company. So if we go to the dividend yield, 3.64%, which is very good considering what the banks are offering nowadays. And everyone loves sugar, so it's a company that will continue on for many, many years to come. Next, we have Evraz Steel. Now, these are free shares I were given. And as you can see, it's 7.41%. They're an iron ore mining company and they make steel. So obviously, the more construction and building projects you have, the more steel that's needed. So again, a very healthy dividend yield. This one shocked me, B&M Retail. So if you don't live in the UK, B&M is like a bigger version of your corner shop where you can find bits and bobs, food, toys, whatever you need. Both were given as a free share, as you can see, and the yield is 9.63%, which is ridiculous. That is a crazy yield. I was honestly impressed and shocked at the same time. Next up, we have an interesting one. It's by iShares and it's actually a bond. It's called Fallen Angels. So if we go into it, they're both free shares, okay, and they track corporate bonds. So basically, loans that have been given to companies, and companies obviously are paying interest on that, and the dividend yield is 4.19%, which is very, very good for a bond. Next up, we have Ashmore Group, which is a debt management company, and again, 2 free shares from them, which I've held on to, 4.26%. A very healthy dividend yield. I have another share that was given free by iShares S&P 500 ETF. It's the same as a Vanguard one, but obviously the Vanguard one is better because it has much lower fees. LG was given as a free share. I've held on, there's no dividend yield, but I think this is a good solid growth company, especially with the battery tech that's coming through. Next up, we have World Mining. Now this is a bit of an odd one. It's a trust that invests in mining companies. And if we go to the yield, again, 3.21% dividend yield. Next up, we have MoneyGram. It's one I'm going to sell out. There is no dividend yield. Another corporate bond ETF, which is given a yield of 2.14%, which isn't bad. And lastly, we have Royal Mail. So deliver parcels. Everyone in the UK knows about Royal Mail. Okay, they have a very good dividend yield of 3.8%. One thing you have to be wary of is if you're buying US dividend stocks. If you are a non-US resident, you have to pay withdrawal tax to the US government. That is at 30%. Now what you can do is if you live in the UK, you can fill in a W8 Ben form that will reduce your withdrawal tax from 30% to 15%. So for example, if you made $100 in dividends and you're a non-US resident, you have to pay $30 as a withdrawal tax. That will reduce to $15 if you fill in the W8 Ben form. So definitely go do that. Please give it a thumbs up and I look forward to seeing you in the next one.